topic we're going to talk about today, I told Rachel earlier, I love this topic. Just having that mindset of an investor. Um, when we're coming into this business of real estate, I know for me, I came in, I don't even know what I was doing. All of a sudden, I'm selling some houses and I'm making some money. And one of the biggest things I saw when I first came into this business is I watched a lot of people get really, really wealthy. Like I watched a lot of my clients. I started to see what they were doing and realized just a lot of commonalities. And I guess one of my thoughts is like that's something we got to start with. Is like start finding mentors or models, people that are doing what you want to do. It could be somebody who's famous that you see, but it could be somebody local. It could be my investor who I just remember selling two investment properties to him. They were $500,000 in each in December, and I'm writing a check for it. And I said, and this guy's like, 38 years old. I'm like, where did he get $1 million to write these checks? And I started to dig into like, what is it people are doing to just change that? And I mean, one of the things I saw is he showed up in a pickup truck, a little bit older. He showed up, no special clothes or anything like that. So he had kind of the millionaire mindset of he was like investing was his exciting thing. A lot of us like be I want that that crazy sports car, I want that huge house. Like personally, I want that next investment property. I want to invest in the next best company. I want to open a different business. Like that for me is exciting. So from a mindset standpoint is really shifting that mindset of you know, is honestly what is really that exciting, or even the books that we read. I remember reading, you know, Robert Kiyosaki's book, and he talks about a Rich Dad Poor Dad. I think it was that book or one of the others. Where his wife wanted this fancy $80,000 car, and they made a decision. They get the car when the investments pay for the car, and that's when you get those fancy things. Because if we just go get stuff, we're always going to have piles of debt and piles of bills that we're just struggling to pay for. And I know I came into this business. I was saying to earlier, Rachel, like you can make really good money in real estate. However, my real estate sales business, it's just my opinion, is worth zero. It's worth nothing. Like it makes really good money while it's going, but the day comes and I want to sell that business, maybe I can work a transition plan and get, somebody to pay me referrals for a few years. Maybe somebody on the team will, I can sell or finance a deal for them to go ahead and take it over. But when I step out, I'm done. So I have to have a plan in place of some sort of what I'm going to do. And that's where I started looking at, investing in rental property. I know Ed owns way more rental property than I do. But looking at like those things that are not exciting. Like I own a lot of rental property and I don't make a lot of money every month off it because I'm paying them off like crazy. So really I built wealth on them, but I don't take any money from those properties either. I'm making money in real estate. I'm buying investment properties and they're doing their thing. They're paying down the mortgage every month. We got into um, you know, property management, which is a regular cash flow business. We got into mortgages, which is a business that I don't have to dive into because the other thing is we can only do one job. I have a job as a real estate agent. That's my job. And it's like how do I get into these other things? And a lot of times it's finding a person. It's got to be a business or there's got to be a person who knows that business that you can pull into it. Because if you don't know the business, you shouldn't be investing in it. But if you have a partner or something, so when I got into property management, I had a person I could put in there as the property manager. Same thing with mortgage. It was somebody who could go in there as the CEO of that business. But really looking at like where can we really go and make money while we're sleeping? Because real estate, I mean, with a real estate team, yes, there's people out there selling houses and all that, but like it's really not a great long-term game plan. It's a great place to get money. One of the things I did really early on is lived off 30 to 50% of what I made and invested the rest. So if I was to say like the biggest thing about the mindset of an investor goes back to that guy with the old pickup truck is I came in, I had a certain salary I was used to making. Once I hit that, I stayed with that budget. And when my income went up, I didn't increase my budget. And I just kept putting money aside, kept putting money aside. And then when the investment opportunities show up, and they will, when people know you're in a position to buy things, they will show up and put things right on your doorstep. But if you don't budget for it, if you don't start putting money aside, you can find people that will sell or finance stuff. You can find these things, which I do that as well. But there's going to be great opportunities that you cannot dive into because you don't have any money. And I know if you don't save any money yourself, somebody else isn't going to loan you theirs. Like, you gotta show some sort of track record too of what you're doing.
So Jim is like when you first like getting into the mindset of like a brand new investor.
Yeah.
What was kind of your target like money, so to speak, to set aside in order to be able to afford some sort of opportunity?
So I guess back then it wasn't a whole lot of money.
Yeah.
I mean, some of the simple stuff. I mean, if we go to somebody who's 20 years old, gets into real estate, never bought a house, honestly, I would tell them go buy an investment property that you can live in. Go buy in our area, we have a lot of 3, 4 unit buildings that you can buy with FHA financing 3.5% down. You go buy a building right now, they're, say $600,000, $700,000. So yes, Kim's pointing out, yeah. So $600,000, $700,000, but let's say you got 30 grand, like you got enough for one building, and that's a great plan too, is you live there for a little bit and then maybe you move to another one that's more like home. Like I've got a friend, he always likes to tell people to do the 4-3-2-1 plan, which is you buy a 4-family, you live in it. Then you buy a 3-family, you live in that. You buy a 2-family, you live in that. And then those 3 buildings pay for your single family. Mm-hmm. Just having those, because the first one can be easy if you're going to live in it. But let's say you got a single family, you're living in it, and you want to go start investing. It's a little trickier because that $700,000 property, I'm going to have to come up with 25%. However, I bought a building a couple of years ago that we put 10% down. I had somebody who knew that we invested in properties. He approached me, he said, I have a friend, he wants to sell or finance this property. Like he doesn't want the big payday. So all he wanted was 10% down. So we came up with, 85 grand on this property. That was a $850,000 property. We went and I put all the numbers in the spreadsheet to figure out what rate we could pay. So we gave him his price at our interest rate, and we're able to make it. It didn't cash flow on day one because the rents were like at 50% of market. So we had to slowly increase those rents. But again, I had mentioned before, it's a long-term play. We increased the rents, we got it to cash flow, but we still have another, 20% that we can increase the rents to get at the market, and that'll all be profit once we actually do that. So at the beginning with it, it's if you're not living in the property, you're probably going to need, like in our market, you're probably going to need a couple $100,000 to purchase that investment property, if that's the route that you're going. And if somebody's making, say $300,000 a year, with very good income, but a lot of team leads are making that or more, and they can find a way to live off of 100 or 150 of that, that adds up very quickly. The other thing that I'm doing, so I have a couple different investment partners that we bought properties with. So I have one property we bought really cheap, say 7 years ago, and we bought it for I think $275,000. We owe $200 on it. It's worth probably $700 right now. So we just went to the bank, and the bank will do a loan where they'll take the equity on that property, and we can go and take that equity. So we don't need any cash out of pocket. We're just taking the equity on that property, and they're going to appraise that property, and we take that equity and go buy the next property. So the first few are always the hardest. Like you've heard people say, like the first million's always the hardest. The first
Mm.
like few properties are always the hardest. And that's why I always say the easiest way to do it is to get a kid when they're young, or that could, or maybe somebody legitimately sells the house they live in and says, you know what, I'm selling my house and I'm just going to go live in this multifamily and make some sacrifices.
Mhm.
That's if you don't have a big pile of cash, that's probably one of the only easy ways to do it. Is to do it as an owner occupant, live there, move to the next one, move to the next one, or or pull out. I mean, financially, it probably doesn't work well because at least in our market, the numbers aren't as good. I know in Ed's market, they're better, but you could pull a line of credit from your house and use that as a down payment. You probably can't tell the bank that, but you can use it as a down payment for an investment property. And if you got 250 equity in your house, you pull that as a line of credit, you go ahead and you put it against that investment property. If it cash flows, there you go. There's your first property. And then down the road, you pay that mortgage down. Maybe if the values go up, you go ahead and refi it out and pull money out later. Those are some of the options.
So, Jim, and I know Ed, maybe you can speak to this. When you're looking at the potential return on a property, what are you looking for in regards to, the value of the property or how much you can get the property for versus what you can rent it out for? Like, is there a formula that you use to identify that?
What do you do, Ed, on this?
I I would say number one, it depends where you're at with your investments at what point or what stage you're at. I think there's a couple different things. Number one, just from the mindset right up front, and then I'll answer that question. There's two different there's two different mindsets with money out there. I think when it comes to this, there's the Dave Ramsey mindset, and then there's the Kiyosaki mindset. And a lot of people come to us and say, we want to invest. And I find out what mindset they're in. And it's like, if you're in the Dave Ramsey mindset and you don't have a bunch of cash saved, it's going to be hard. So now you got to go with the Kiyosaki mindset where you're using somebody else's money to make more money. And that's really what we've done over the years is we would go out and do that. I think there's a couple things you need to know going into this. Number one, you need to understand the rental market. So if you're getting ready to buy rental property, but you don't understand rental rates, that's going to be a problem, right? Because you can't figure out the formula correctly. You just can't say, I hope it rents for this. Hope doesn't work, unfortunately. So you better know the rental market and know the rates. And quite honestly, what Jim was just talking about is the benefit of knowing the rental market is that you can go find a property where I'm going to tell you right now, 75% of people out there rent their stuff too cheap. We do a really good job of pushing those rents as high as we can get them. And, some people are like, gosh, that's awful mean. You're trying to get, well, you know what? I'm an investor. What do you expect? I mean, I want the most return on my money, and the market will tell me whether or not I can get that or not. So I think knowing the rental rates, understanding maintenance cost, having a history of understanding maintenance. If it's an older property, a lot of times we'll use 10% on maintenance. If it's a brand new property, the first 5 years, we may use 3% on maintenance. Understanding the equation, the math equation. I mean, here's my rental income. Here's all my expenses. What's my note? If I'm paying a note. And my dad taught me a long time ago, the cheapest money you can find to take is your house. And I know that scares most people. And what I tell people, if it scares you, don't do it. It's fine. Yeah. But you're not going to do this without scaring yourself a little bit at some point. Now, what happens is you start and you're scared, and then you find out, wow, this may work. And you get better and better, and you get more confident in what you're doing. But the cheapest money you're going to find is on a HELOC loan on your house, probably. And, you still have two assets, so it's not like you've went out and blown 200,000-300,000 on a property. You still have that asset, and that asset's not going to move too much. I mean, depending, if you're on the East Coast, West Coast, it's going to move a little more. Here in the Midwest, we don't see those values move up and down as drastic. But over time, they definitely move up. And so now you got somebody who's, as I always say, is buying me a house. The renter's buying me a house, and I appreciate them. And while that's happening, they're paying down on my principal, and my assets appreciating at the same time. And so that gap gets bigger and bigger as the farther we go, and that's kind of fun.
One thing you kind of hit on there is anybody I've seen super successful does not have super crazy complicated formulas. They don't have these special spreadsheets. Well, I actually have a spreadsheet I use, but it's usually nothing crazy. And Ed just talked about it. Like I pulled a 250 HELOC on my house. I went and bought a property that I could buy at it was 180 that was worth 280 on the day I bought it. That seems like a really good use of that money, and at I think 7.25%.
And were the rents too low?
So the rents were 1,400, where the market was about 22.
Okay. So that is another piece of that equation, right? Hey, I can take that up so I can make more income on it, and I'm buying it for less than what I should. So that gap's really big there. That's a win.
So yeah, putting yourself in a place of opportunity. So if, like Ed said, that is the cheapest money. So if somebody's in a spot where like I don't have any money, but I really want to invest, honestly, a line of credit on your house is probably like, I know the bank around me will go up to 250, up to 100% of equity, but you got to know what you're doing. You got to know what you're doing with this, and I think Ed touched on it a little. Is the renter is paying your mortgage. So like the three ways that you make money in real estate by owning real estate is you pay down the mortgage, potentially capital appreciation plus cash flow. You can't get that anywhere else. You get it in like the stock market if you have a high dividend stock.
And tax benefits.
Yes, and now you also get to you get to make money on a property, and then on paper it shows you lost money. You depreciate it. So I keep it super. So I have a complicated spreadsheet, I'd say, but I keep it super simple. That spreadsheet has the costs Ed talked about. It has the maintenance costs, it has all the hard costs. It has capital expenditures. It has one thing that people miss. Whether you're going to have a property manager or not, if you're going to build this, you need to build that into your spreadsheet. You got to build a property management fee into there, and it's got to still make sense. You got to have some sort of vacancy cost based on where you are. Maybe it's a 5% or a 10% vacancy. After I put all that in the spreadsheet, if the number is greater than 0, I will buy it. That's my formula. Because again, if that's 0, that means all the costs are taken care of, and I get a free building that my tenant paid. I'd like to make money on it, yes, but as long as it's 0, I'm happy.
I think that's a really interesting point, because I think what keeps a lot of people from investing is this promise of it needs to cash flow. Like the only way it makes sense is if it cash flows. When, Jim, to your point, like the acquisition of the real estate, the tax depreciation that you're able to take, and then owning it in the long term, that's the win, right? Like that's the money you're making. So I think getting into the mindset, of it's okay if it's 0. Like that's good if it's 0. Now it's covering its own cost, and now I own it, and it's building appreciation, and that person has a place to live, and they're buying my house for me. I think that's totally a great point.
That's exactly what how we look at a lot of things right now at the level we're at. It's like we're building brand new properties, and at the end of the day, if they pay for themselves, that's all I care. And my wife's heard me say this a million times, and I think it bugs her sometimes, but it's like, as long as it pays for itself, we don't need anything else, because the asset is just going to get better and better, and it's just open opportunities up.
What I found when we talked about the low rents, what I found is some of the best opportunities I've found are situations where somebody's owned the property forever, they've managed it themselves, they can't increase the rents. Like they personally just are unable to do it. They don't have it in them to actually increase the rents. They feel like they're hurting their tenants by doing it. So in that scenario, like you're going to buy it at somewhat of a discount because they can't if they have rents that are 50% of market. So the building I bought, I probably bought it at 75 to 80% of market value had the rents been at market value. So it didn't cash flow on day one. I had to go ahead and get the rents up, which I was able to. So this is the other piece of it too.
That's just part of the formula, isn't it?
Exactly. You just got to look. I looked at it, and the fact I was losing money on day one, I knew I had to have a huge upside, which I did. It's a huge upside on it, but I think I was taking in like 7 or 8 grand a month on a $850,000 building where I should be taking in like 11 or 12 grand, well, 12 grand a month. And that was the upside on what's there. And there's other things like you can, a great way to continue to buy those properties is let's say you buy that multifamily that you had to come up with 200 grand. You buy it for, 800,000. And you go and do a cost segregation study for, I think I paid 2 or 3 grand a piece, which basically goes and accelerates the depreciation schedule to put more money back in your pocket so you have more money to go buy the next one. And it's just, there's all these different ways to do it, to go ahead and get to that next one. So other thing I would say on this whole investment realm is again watching who you follow and which direction you want to go. Ed talked about it briefly, like he talked about Dave Ramsey, which if you're not familiar, Dave is all about everything needs to be cash. You buy an investment property, it's all cash. You if you don't have the cash, don't do it. And Robert Kiyosaki is use everybody else's money, never touch any of your own money. And I found that there's some spot in the middle of the two of those that works out really well, which is, going ahead and planning on using my own money, but always looking for opportunities where somebody else is willing to use theirs. Like I'll give you an example, a partnership that I did, which actually might be something really good. If you're sitting there and say you keep stumbling across opportunities and you're just like, I don't have the money for this. I don't have the money for this. Is I had an opportunity where I had a friend who came to me and he said, hey, like I got this opportunity, but I don't have any money. And we worked out a deal. It worked out really well for me. It worked out really well for him, where I gave him 25% equity in the property for putting the deal together. And I actually let him manage the property for a period of a few years for free to work in the next 25%. We became 50%, 50-50 partners. Initially, I wasn't sure how much I loved it. However, if I look at it, I'm the guy with the money. I didn't have time to deal with it, so I wouldn't have bought it otherwise. And this is that same property that we bought for 275. We owe 200 on it, is now worth 700. That basically 30 grand I essentially gave him worked out okay for me. Now I have a couple 100,000 in equity putting that investment in, plus it's cash flowed like crazy. So we've gotten all that money back already in the cash flow every month too. So that's an opportunity for someone to look at. If you're coming across opportunities, find someone in your world who maybe doesn't know the real estate business well enough or isn't going to find those opportunities that you can partner with. Not a fan of partnering with everybody, but because that's a big deal when you start doing that partnership. But for me, it's worked out on that one. I think we've been 6 years partnership, and I've got one other that's I did with an agent on my team where we bought some properties together, as kind of more of an education thing. I know Dave is raising his hand. Go ahead, Dave.
Thank you. And I just thought I would briefly share a little bit of what I've been doing on the investment side. Something that's worked for me was this is only my 4th year in. So what I'm doing now is I'm putting some cash, stockpiling cash on the side before I buy my first property. But in the meantime, what I'm doing is I get a lot of off-market properties and I get an acquisition for those. And then once my investor fixes it, I'm the listing agent. So now I have basically a stream of annuities that I'm getting paid on both ends for at different times of the year, about a 90-day difference. So the other thing I started doing is I'm raising capital for a senior living rollout, which is going to provide me horizontal and passive income where I'm not putting any money into it. So now, as I'm building cash on the side from these annuity, as I like to call them, the annuity acquisition and the listings, along with the passive income in raising capital, once I'm ready, which will be sooner than later, one of these properties that I'm acquiring off market, I'll just take over one of those properties on the acquisition side. And I'll have enough for a down payment and whatever else I want to do with it. And then of course to leverage that out. So does that make sense?
Absolutely. Well, you're in that world where you're coming across these properties, which is huge because not everybody's in that. Like we advertise, we'll buy your property, so that helps. So people call and ask for offers on their properties and things like that. And every once in a while, I bought one property where I had sent something in the mail to the guy. He eventually passed away, and then his brother found it when he was going through his brother's stuff, called me, asked me if I would buy the place, and I gave him an offer. I was I'm very transparent when I do that. I tell them like, hey, here's my offer, here's the market value, this is what I'm doing, this is what I'm going to make, just so they completely know the whole story, just to cover myself. I don't want anybody think I'm doing anything sneaky there. So one thing on this mindset of invested, I did want to touch on. So we talked a lot about real estate. Is just in general, like I came into it and like kind of stumbled into real estate investing a little bit, and along that way, like I would think of like I need to get big numbers when I'm investing, rather than looking at what is my return on investment. And a great example of that is, so we flip properties as well. So we have one that should be going on record today, the closing that we sold. We made like 60 grand on the property. And I did that with a couple partners within a team. But if I look at it, the money that we put in to do that flip, and most of the time we do it with cash just because it's easier, because I don't like people telling me what to do and when to do it, or when they're going to hand me money. But within 6 months, we earned essentially 50% annualized return. So I try to look, when I'm looking at an investment, is I try to look at the annualized return and compare one investment versus another. So like that investment is really great. If I'm not making a return like that, I don't know if I want to take a risk on that, because we had 2 flips that we did, which one of them, we put about 10,000 into it and we made about 70,000 over a period of 3 months. And we had another one that we, completely gutted, and they both sold for the same price, which took us 12 months and made about the same amount of money, about 70 grand. That was not a great investment. The one that took us a whole year, because our return was 25% of what the other return was, because after 3 months we get the money back, so we could go do that 3 more times. So one thing I think we get caught up in when we look at opportunities is again, patience is such a virtue. Is we're like, oh, I want to go make all this money. It's like, well, go make the money and then go make it again and make it again. So if you're doing flips, that's a great thing to think about. But even just looking at, I try to look at any investment as a good investment. If you come to me and you have a cleaning company, I'm going to sit down with you. I want to talk about what that business is that you want to sell to me. If it makes sense and I have somebody that can run it, I'm going to buy it. So part of the mindset of an investor is trying to get outside the box of just real estate. And if you're in a position where you're making money and there's money sitting in the bank, and you're like, what do I invest in? And I know for me, one of the challenges I have is I don't get enough real estate investing opportunities in front of me. Like I don't have enough, I prefer to buy rentals. Long-term rentals is what I prefer. I know Ed is building them because he can't find them, but I don't have enough of those opportunities. I will do the flips if they completely make sense. And one thing I make sure with that is if I'm doing that flip, I will give myself a margin of safety where there's absolutely almost no way I can lose money. I've never lost money on a flip. I've come really close with some really bad situations. I won't go into all the details, but they were super messy. And I think the worst I did is I made $10,000 on a flip where I had to re-roof it twice because the roofer did a crappy job the first time, and I didn't feel comfortable with putting that product out there. But going and only buying the properties that you know, because I go in when I'm going to buy a property, I don't want to buy it. So if you ask me to come do an offer on the property, that's at least my approach. I'm like, I don't want to buy it, but if you want me to buy it, here's my number. Because I need to know that when I'm done with it, because that's a totally different animal than rental. Rental, you can screw up big time and it works out. I bought a really bad investment 20 years ago. It was a 2-family. I lived in it. It did not cash flow. The market crashed. The value was, I owed 100,000 more than it was worth, but I still have it today. And that's something to think about. And I learned this from some people that were old like me that have owned property for a while is when you go through those cycles, you get to see what happens when you just don't sell it. That's when you lose money, is when you sell it. So today, this property I bought for 280, it dropped in value to 180. Now it's back up to like 500 and I owe like 150. So right now I have $300,000 to $350,000 worth of equity. It cash flows, and it was probably one of the stupidest investments I could have made. And my point with that is most of us sit on the sidelines way too long trying to figure out this perfect investment opportunity when what we really need to do is get our feet wet. If we don't know what we're doing, like, and honestly, anybody on this call, anybody listening to the recording, you're looking at an opportunity and you just want a second set of eyes to look at it. Obviously, I wouldn't know your market. I'm happy to look at it and see if it makes sense and explain to you what I would do, because I think that's super valuable, is to have other people look at it and because I can talk in theory, but to really just say, hey, like, and even asking questions on the expenses, because most of the time people don't look at all the expenses. So Kim, I know, shared that spreadsheet that I use. I just stole it from a commercial lender that was using it. And I was like, hey, this is great. But like half of those expenses, when people are buying buildings, they don't look at. And those are legitimate expenses you need to look at. So I won't buy pretty much anything that's on the market, in our market, I will not buy. Unless it was seller financed and I could get it at like a 4 or 5% rate, then I could maybe make the numbers work. But it's real estate, buy and hold stuff in our market right now is not an easy investment. So I have to look at, where does my money do best? So I'm not going to buy real estate just because I know it. I need to find other places. So that's why I look at, we're looking at a potential acquisition we have a property management business, and we're looking at acquisition of another property management business. So I'll be honest, I like that business a lot because it cash flows every month. You don't feel like there's a ton of competition. And there's so many other opportunities that for other types of businesses that you can tie to that, that I just think it's a better long-term business, and you can actually sell it. Unlike my real estate business, it's ain't worth shit.
Mm-hmm. Can you guys speak to, like, when you're going, say people or you're meeting people in your market who really, like, a traditional retail sales experience isn't going to be in their best interest, right?
Mm-hmm.
Look, we have one right now that our team might be approaching. And this poor lady is like, she's lived in the home forever. Her husband passed away. He was a hoarder. She's not done anything with his stuff. She does not want people to come through that house.
Mm-hmm.
She does not. And it needs a ton of work, but it likely has a good ROI. How do you guys go about, pitching that to that particular client? Like, what number is good for her, like, without obviously ripping her off?
Yeah. So again, I always give the 2 numbers, which is, well, 3. No, in that scenario, it's probably just 2 numbers. It's like, hey, if we bring, because she doesn't want to bring people. I just bought the one we're closing today. It was a similar situation. There was like 8, 9 people living in the house. There was like 30 animals. It was crazy.
Ugh,
And I was like, honestly, your
nope.
most money is the open market. We can go and do almost like a showing block for a couple hours and bring people through. I think you'll probably get 250 for the building. Um, I will buy it. However, I don't think that's in your best interest. I'm going to buy it for 180. You're going to get, you're going to net probably 10 or 15 grand based on the mortgage you have. Those are your options. So I'm pitching it as like, I don't want to do this, but I will. So I bought that one that way. Another one I just bought was actually my friend's mom called me and was like, hey, I got a foreclosure date in like 3 days. I got this investor who came in and offered to buy the house for X amount of dollars. And I'm like, let me sit down with you and figure this out. Like, I can probably pay you more than that and get you out of the foreclosure because she couldn't even sell it for that price anyway. And I had to negotiate with the banks to essentially do a short sale on that situation because she owed like 130 on it. And I looked at the numbers. I'm like, maybe I can pay 100. This other person was paying 70. That one was easy because somebody else was already paying less. But I look at every one of those scenarios and I say, I always put the option out there, but I never say, hey, this is your best option. Because most of the time it's not. I would say 9 out of 10 times when they take my offer, I tell them it's not the best one because I don't think it's the best option. I don't think I've ever gone in there thinking like they should take my offer.
We do.
Well, I think that in and of itself like lowers sales resistance, right? Because you're telling them up front, like this is, in my opinion, this is not your best interest, but for them, the convenience of it and the lack of like the getting to avoid any potential or perceived embarrassment on the market, right, is what they're okay with. So,
well, and if you guys go through, and I don't know I heard what you do, Jim. It's not always about price is what Rachel's saying, and it's not. And so to say this is your best, well, it's not your best because in all reality, a lot of times to get that price that you're saying, you got to do a lot of work, and that's a lot of time, and that's extra money out of pocket. And so I think the iBuy program is really good. We do it and we love it. We use it a lot. But I think it's all about saying, here's the options in front of you. This is your house value like it is. Here's your house value if we'll go fix it up. Here's your house value if I just buy it and just take care of it. And the cool thing is, if I buy it, you don't have to do anything. You live in the house for the next 30 days. We close on the 30th day or whatever the time frame is because we're flexible. And we even
stay for another 6 months.
Yeah, or whatever we need to do.
Yeah.
We're not going to close until then, obviously, but the thing is, I want to make it the easiest option for them on the iBuy because I tell them, you don't have to do anything. You live here. You don't have to do anything for the next 30, 60, 90 days, whatever it is. And when you're done, just walk out and you leave whatever you want to leave. We'll take care of everything. You don't have maintenance now. You don't have commission. You don't have a lot of fees at the bank because we're going to take care of the closing fees. The whole idea of iBuy is to make it the easiest thing ever and let them just not have to worry about a thing. And there's more people out there that will do that than you think.
So are you, tactical question, just because I'm super curious myself. Do you do an actual sale, like a recording of a sale with that type of situation, or do you do like a deed transfer?
Typically a sale.
Okay. Yeah. Okay. Dave, you had your hand up for a minute.
I think that transparency is really important that you brought up too. So back to like when I'm getting these properties off market, what I say to the seller who could be the executor or the beneficiary in an estate situation, I say to them that we have two options. I can be your realtor, and then we have an agency relationship. I represent you, and this is what we'll do, some minor clean out. It's going to cost you this. Here's your net sheet. You're going to have to pay for these closing costs, but you're going to get more probably 95% of the time. It's just going to take more time, effort, and work. There's going to be showings. There might be negotiation. And then I flip over and say to them, we can wholesale this property. What this means is I am no longer representing you right now. What I'm going to do is I'm going to find you buyers. And when I find you buyers, you're going to sign a sheet that says, I do not represent you, that I'm representing the buyers. You're going to see my exact commission on the sale. And we're going to give you this net amount where you don't pay anything. So I literally like spell it out very clear on both ends where I'm representing them, and then on the other end where I'm not representing them. And even when I'm not representing them, a lot of times the buyer that I bring or that I find, the investor, like their attorney ends up creating title. They don't talk to them directly, but they end up creating title anyway, because this person usually doesn't know what they're doing and they just want everything done and they don't even want to pay for an attorney. But they're signing documents knowing that I am not representing them in that case. And this is the exact dollar amount I'm going to make on the acquisition. So now more than ever, that's super important to be transparent. And let them know and have them sign docs who they're actually being represented by and who they're not being represented by.
There was one thing that Ed had said that I'm probably not going to do much more of, but I bought a lot of properties with people in place that are there after closing. But again, any risk you take like that, you have to look at a price. If it still makes sense at that price with the margin of safety, knowing that you're not going to lose money, and maybe it's 25 grand based on evicting them, what you're going to have to do for trash outs, because trash gets expensive, things like that. It's still worth it. I don't know if it's worth it stress wise, but it can be worth it, financially. And that sometimes is it. Like I've had it where it's a single family that they're renting out, and I had one where they didn't want to tell the tenants until like literally almost the day of closing, and I ended up calling the tenants and actually meeting with the tenants and working a deal out with them. But that can be like a value prop that you're bringing too, is like, you're going to take literally all the stress off. But if I'm doing that, my price is very low. But it's worked out in a couple scenarios where they didn't deal with any stress. I did. And in the end, it still worked out and it made a ton of sense.
And now you're stress free. Look at that.
Yeah, I still have one tenant that I don't know if I'm ever gonna not have. Because I just said part of the deal was allowing them to stay till they could find another place at a rent that was probably less than what it cost me to hold the property. Right. But it was part of the deal. And again, it makes sense, but I wouldn't do that in your first situation.
Well, here's some other things now that you bring that up. Here's a few other things I think you ought to think about. It's not only just getting the property bought, getting it fixed, whatever it is. And this is not iBuy, this is just rentals now. But it's also, if you're not, early on, we didn't have a management company, and I was the guy, right? And I managed our properties. Early on, that's hard, especially if you've got another job or but anything worth doing that's going to give you big return is going to be hard. If not, everybody'd be doing it. And I know a lot of people out there that have one rental property and they go, yeah, I'm an investor, I got a rental property. And I go, yeah, that doesn't count. Sorry. I mean, that's just a headache. All that is. It's not, unless that rental property is bringing in a buttload of money every month for you, that's just a headache. So if you're going to get in this business, you need to have, a pile of them, whatever that looks like to you, 10, 20, whatever, or more. You need to be in there, because that's what's going to create. There's lots of my friends that say, hey, help me get 10 or 15 houses. Let's get them paid off by, 20 years from now. And then in 20 years, they've got these houses that they can either sell and take a buttload of cash and go do something with, or they can just have steady income coming in. But you're going to be in the business somehow, and it is going to take some time and some effort and maybe you're the person that's going over and fixing things. Maybe you're not, and you're hiring that out, but you better have your money right on that and your numbers right on that, because we know in the trades world, everything's gone up probably 200%. And so therefore, what we're seeing is in the trades world, everything's higher right now, just in the last few years, right? And we're also seeing insurance has gone up, and we've also seen mortgage, money cost more now. So we have to be paying attention to our income side of that the whole time as well, to make sure that, I just know so many people that leave it alone, and it's like, yeah, they've been great renters, so I've just left their rent alone. Bull crap. They're great renters, and costs have gone up. So you're going to sit there and eat that cost. Now you're not making any money. That just
Now
doesn't
you
make.
need to sell. Now you need to sell because you're not making any money. But
Yeah.
I agree with your comment. I always tell people you need to at least have 10 doors to even get in the gate. Like you need to have a plan to at least get to 10. More is better, because if you got 2 doors, 1 door, 3 doors,
Oh my
when you have
God.
a vacancy, you're writing checks every month.
Yeah.
But if you have 10 doors, 12 doors, now all of a sudden you have a vacancy and you don't even care. You have a vacancy and it will get filled when it gets filled, but you're not going to make a stupid decision and rent it to somebody that you shouldn't.
Right.
Yeah, such a good point.
And just like in our businesses, our real estate businesses, I'm sure there's things that everybody puts in from a cost perspective that helps offset your personal cost.
Yep.
Same way in rentals. I mean, I don't pay for my trash. I don't pay for my house to be cleaned. We've got a cleaner that cleans all our houses. She does mine differently, right? That's got to be a bill on some other house. It's not my house. So there are things you can do to start offsetting your personal costs as well, just like in your other businesses. So that's kind of fun.
I almost feel like we should do a part 2 of this, like
Yeah.
organization of the rentals once acquired. I like it. That's
Yeah,
good, guys.
I'm down. I think me and Ed both enjoy this conversation. So,
Yeah, I love it.
It's a good one.
well, this was awesome. I'm glad we got to do this. And yeah, we'll have to add a part 2. We'll have to talk about what that part 2 looks like, Ed, and we'll get that set up. And everybody have an awesome week, and we will be back and see you again next week, same time.
Thanks, guys.
Thanks.